Right next to, you see at the bottom of the call, there should be like a microphone.
I see the microphone. Oh, there it is.
Yeah.
So you guys seen it?
I just got pictures of them, but I don't see anything up yet. I don't think I have to do anything.
No,
I'm
it's
new to
good.
this too, so.
Just give it a second. It's just processing right now. I see a black screen. No, you got it. You had it, Lewis. It was just on the wrong screen, I think. So you're just a one screen, or you can share the.
Yeah, here we go. I think I did it wrong.
There we go.
All right, there we go. So this is our last as of July of 2025. So as of July 2025, we've deployed a total of 253 million, and we have a internal rate of return of 17.3% on our liquidated portfolio. But when we mark our book, right, we're forecasting the balance based on updated values, updated timelines, and all that stuff. So liquidated, we're at 17.3%. But if we include our forecasted, assuming we don't acquire anything else, we're just going to liquidate the portfolio, we're about, just over 15% unlevered return. And you can see this is
that 15% annual return or 15% over what time period?
It's internal rate of return. So it's 15% over whatever time period collectively that we are liquidating the portfolio. So every pool, every loan is different, as far as timeline. So this is a weighted average internal rate of return, so that it takes into consideration timeline. So when we liquidate, right, we actually have actual timeline and proceeds, so we can calculate internal rate of return. And then our forecast, we forecast out when we think we're going to liquidate it and what we think our proceeds are going to be, and then calculate internal rate of return. So then we bring them together, and then that gives us the actual and reforecasted mark. So again, as of July, if we didn't buy anything else and we just liquidated the balance of our portfolio, we're at about just over 15. Here, this is our liquidated portfolio. So out of almost 1,500 assets, 276 million, we're at 17% unlevered returns. So, I think the fund is basically stating, I think we have a 9% preferred target return of 12% to 12 to 15% roughly, kind of be on the safe side. But our historical performance has been on the liquidated 17. So we're being conservative on on what we think we're going to return to the investors.
Okay, so is this whole fund, all of this, the total 1,700 loans, is that all reverse mortgages?
No, it's a combination of regular NPL acquisitions. So with Ballbeck, do you know who Ballbeck is?
No, I'm not familiar with.
They're one of the largest funds in the space. I think they have like 5 to 7 billion under management. So we did a decent amount of work with them. These guys, we bought NPLs with borrowers in them. So those were forward mortgages. Beltway's a family office. We only did HECMs with them. Castle Rock is a small private equity fund. We did a mix of everything with them. We did HECMs, forward, REO, foreclosure sales. Same with CV, same with Evergreen, same with InSource, same with Investment Funding Inc. We only did real estate. We didn't buy any loans with them. We only just bought REO. So we bought pools of REO. Javelin, we did everything. Except for the HECMs. We did forward NPLs and REO. Kirkland, we did forward NPLs. Oval, we did primarily REO. Rincon, primarily REO. EFP, we did a combination of REO, forwards, and HECMs. Pikes Peak, we did a combination of everything. Thousand Keys, combination of everything.
So if I think one of the things, if he says, or if we talk to investors and it's 17% and it's a 5-year fund, so then we divide that 17 by 5 to see what it's annual. Is that what that works out to be?
No, the 17% is a 70% total rate of return over the 5-year period.
So it'd be 17% after you per year.
17% after 5 years.
Yeah.
The fund runs for 5 years. So it'll be a 17% internal rate of return after 5 years. Now we'll be giving you guys updates. I mean, whether we're executing higher or lower than that, you guys have updates. RDMO 1, you know, this we did a combination of everything with our first Reg D, and you know we're at 18% as of July 2025. We just took down our last trade in the last HECM auction with RDMO. Now it's in liquidation mode.
So if you invested 100,000, what type of example? How would I give that? Tell him the example on that. If you invest 100,000 in 5 years, you'd get like 17 grand, or what would that? How would that be?
Well, you get 9% preferred, right? Paid quarterly, right, which is about a little over 9% APR.
Let me just calculate that for you real quick.
Yeah, let's just make sure we're on the same page with the math.
Yeah, it's not an ROI; it's an IRR. So it does take.
Jeez, Tom.
You should make
actually, it would be 17,000 per year. Yeah, because we're generating a 70% IRR.
17.
Yeah.
Okay.
So overall, there is the back end. You've got some significant back end promo, or well, maybe you can explain to me a little bit about each one of these columns. I see and yours is very hard to read because it's so small, but so I'm looking at the one that Jasmine, which was dated 9/something/25, but loan count acquisition, that's pretty self-explanatory. Purchase price, pretty self-explanatory. UB, unpaid balance on acquisition, acquisition BPO, and reconciled BPO. What's the difference between the acquisition BPO? I'm assuming you bought the 205 loans at 18.9 million. Is it based upon the UPB on the acquisition?
No, we usually buy assets that are going to go to foreclosure sale to REO, because that's what we feel like our niche is. We have
and upside down.
Yeah, so we generally our bids are generally a percent of value.
Okay.
Yeah.
But was it so you bought? Well, let me. I guess you paid 18.9 million for 105 loans, but based upon which value? The 20 million 20.5 million or 27.1 million or the 22.6 million?
I don't know where you're looking at.
Okay. I'm looking at,
Yeah, because his numbers are different. Because is there any way you can make yours bigger, Lewis?
yeah, I can't read it. It's so small in there.
Should be able to make it bigger.
Click up there, right there.
There you go. We're getting there.
Is that too big?
Should be able to. I've got this and I'm trying to figure out. I'm new to this Google stuff. I got to figure it out because I've been using Google, my Gmail account. I was a beta tester for Google, and so I've got that easy. But okay, so if we're looking at RDMO and it shows 105 loans, so we're on line 132. Column C, 105. Your acquisition price was 18.9. And the UB unpaid balance upon acquisition is 21.7. The acquisition BPO.
So the problem you're going to have if you look at it this way is RDMO bought a lot of REO. So when we buy REO, there is no UPB. So it's going to be 0. So that UPB number is not reflective of every single asset, because if we're buying a foreclosure sale or an REO, the UPB is 0.
So RDMO bought both. I thought that was a reverse mortgage fund.
No, we bought reverse mortgages, we bought foreclosure sales, we bought REO, we bought forward mortgages. Yeah, we bought everything. Yeah, we're just not going after HECMs. We're going after, I mean, RDMO would be a good example. We're going to be going after everything that we can get our hands on, because we dig up little niches that other larger investors ignore. So the value, the acquisition BPO value would be a more accurate number to look at, because since we are buying everything that's going to go to real estate, we're bidding at percent of value. So if the acquisition, and I wouldn't even look at the reconciled BPO, because I would just look at the acquisition BPO. So, out of 27 million, we paid 18 million on value. So I would look at that, because even the reconciled BPO, all those,
Right.
If we feel like the value is correct or even higher, we don't have a reconciled BPO. We're using the seller's value. So in some cases, we're using the seller's value, or we are or the value is higher and we don't consider it higher. So the best number on this sheet is to look at value.
So basically, if I do my math right, if you paid 18.9 on a acquisition BPO of 27, you bought it at 70 cents on the dollar.
Exactly. That's
what I'm trying to get to is what's your number? But do you analyze each loan and underwrite each loan separately, or each?
Yes. So let me. On the HECMs, we are always right around 68 to 70% of value, our bid.
Okay.
When we bought SB 1079 or CWCOT, sometimes we're down to 50% of value, but those deals aren't as large, so we're not deploying as much capital. Okay. So the deals are smaller, but the returns are great. But when we're deploying a lot of money, it's usually with the HECMs, and we're usually around 7. But let me walk you through our. And I can email this to you as well.
So is RDMO2 is going to be not strictly HECMs, they're going to be also whatever you can find that makes sense to put into the fund.
Exactly. Yeah.
From a distressed asset point of view, though, right? Because everything we're doing is so we can liquidate it and kind of turn it out and velocity of money and get rid of it, if I'm correct.
Yeah. I mean, we may do some bridge lending. We may buy assets to hold, but primarily we'll be buying assets to liquidate. So this is what we do for due diligence. So we do the first thing is evaluation. So let's assume we're just talking about HECMs, because that's the biggest trade in front of us right now. To bid, the only due diligence we do is valuation. So we're utilizing our agent networks. We have a nationwide network. They drive the property. We get interior, if it's vacant, and they're selling occupied and vacant now, but historically we bought almost all vacant. We get interior property inspections with interior photos. We get interior BPOs. So we send this information to our agent on the ground who drives the property, and he provides us a reconciled value based on his input. So sometimes it's higher, sometimes it's lower. And then on that, we say we bid 20 million and we bid, and then we win 5 million. We get an award of 5 million. So we bid 30 assets and we win 15 assets. So once we get an award, then we go into loan due diligence. And the loan due diligence is the collateral review, origination compliance, foreclosure. All the HECMs haven't started foreclosure, but when we buy forward mortgages, often they are most of the way through the foreclosure. So then we're, speaking with attorneys, looking at the foreclosure files and determining, if anything's weird going with the foreclosure. Forward mortgages, we've bought bankruptcy before, but HECMs, there's no bankruptcy. We run title, tax, liens, and judgments. So we'll run title, and we will determine if there's any delinquent taxes, ensure that we're in a first lien position. We also run code and demo to make sure there's no demo notices on the property. And so we'll run all the title and that sort of thing. And then we do a servicing file review, which again, on the HECMs, there's nothing there because the borrowers are passed away. But if we're buying forward mortgages, we're generally reviewing, servicer comments, what type of communication do they have? Do they have communication? Any previous loan modification agreements, any of that? But again, all that's irrelevant with HECMs. And then payment history, again, kind of irrelevant with the HECMs, but on the forward mortgages, we got, we shore up and make sure that the payment history the servicer has is correct. Again, origination compliance review. Again, this not really, the HECMs are such a straight, easy trade. It's incredible. But if we're buying forward mortgages, we do an origination compliance review, because if the loan was not originated compliant, it could void the mortgage. So we go through an origination compliance review.
I did a lot of that with Union Bank when they decided not to portfolio their loans anymore. I spent a couple of years underwriting all the loans with the team so we could sell them on the secondary marketing and make sure that they were, back then, if balloon loans could not be sold anymore. So we had to put riders on almost every loan that says with the refinance option that Fannie Mae, Freddie Mac came out with. So anyway, I didn't mean to, you said can I get a copy of that when you get a chance so I can kind of look through it?
And also on the, because these are all FHA insured, we know they're compliant, right? Because FHA went through them and verified them and insured them. So, and so a lot of this stuff is not even relevant on the HECMs because it's such a straightforward trade. It's so easy. It's a great trade. But yeah, I can forward this to you.
Okay, and there might be. You said that after you win a portion, say you win $5 million, then you do the loan due diligence. Is there recourse on there? Or are you buying non-recourse where, hey, this loan isn't in compliance with documentations, this and that. So
so HUD has really good warrants, some warrants that guarantee first name position, guarantee.
You got very muffled. Sorry, Lewis. Both of you are off screen now.
Yeah, I don't know what happened, Lewis. It's hard to hear you for a second. Let's try it again. Hold on. Can you hear me better now?
I can hear you fine.
Okay.
My camera's been doing this late. I don't know what the issue is.
It's not so much your camera.
Your cameras don't like my ugly face.
It's not so much your camera, it's your voice a little bit, but let's see if we can hear you better. Otherwise, I think I feel comfortable answering that, but go ahead.
Okay.
There you are.
Wait, I just turned off the internet. See if it comes back on. Yeah, I keep getting an error message saying my camera might be blocked due to privacy issues. Huh.
It's the NSA messing with your cameras.
Yeah, that's so bizarre. This has just been happening over the last week or so. Anyway, I'll just keep going. So yeah, they guarantee first lien position, marketable title, property is vacant, no surviving heirs, and taxes are current. So the reps are really good. However, when we go through low due diligence, and if we identify something that, say we identify a senior lien or we identify delinquent taxes, because HUD is doing so many trades at one time, they ask us to fund it, and then they open up a breach portal afterwards. And then once the breach portal is open after the trade's completed, then we go in there and submit the documentation, and they'll either cure it or they buy back. So
Okay.
yeah.
So there is some recourse when you're doing your due diligence to be able to confirm that what we're getting is what we expected.
Exactly. And out of all, I think we've had maybe 2 to 3 buybacks out of the couple hundred that we've acquired. We've had some other lien issues, but HUD clears them up, and we've had delinquent taxes and HUD pays them. So they're a great counterparty. It's the government, so they're not gonna, the people that are, it's not their own money, right? So they're not trying to screw anybody over. It's the taxpayers' money. So they're it's a pretty straightforward process. We just got to show them the documentation and all that, and they'll take care of it.
Okay.
Yeah. But in other trades we do, we bought a lot of foreclosure sales. Those we same due diligence process. When we're buying foreclosure sales, we'll run title that converts to an owner's policy. So if we buy it, it converts to an owner's policy, and we're insured. We buy pools of REO, kind of the same thing. And if we're buying forward mortgages, which we haven't bought in a long time, there's just not a whole lot of those around.
What's a forward mortgage compared to?
That's a loan with the borrower actually in the property.
I'm sorry, I missed the last part.
It's a loan with the borrower in the property.
Oh, okay.
Yeah, they only call them forward now because there's a reverse. So now they call them forward mortgages.
Okay.
Yeah, so then the loan due diligence, like the foreclosure, bankruptcy, all that stuff comes with it. We dig more deep into that if it's foreclosure, bankruptcy. But again, we haven't really acquired hardly any over the last 4 years. It's all been the reverse in REO and foreclosure sales.
So yeah, you'd have to plan on getting an eviction on anybody in there.
Right.
I'm sorry.
And it's just like you were saying, as far as the straightforwardness of the play, like the condition of the properties have been pretty pleasantly surprised, especially as he was saying, he didn't say they're in this call, but even the ones that we're finding that are occupied are even better than the ones we have now. And this is because I used to deal with some really terrible assets. I got them from some really bad hedge funds, but yeah, for the most part, these are not that bad. When I'm looking at some of these BPOs, they're pretty amazing.
Yeah, also we slice out low value. We don't buy low value assets. So lowest will go about 150, and max will go 450. And we always carve out a pool that's in average condition in good neighborhoods. We avoid rural. We avoid some urban. We avoid apartments. But this last pool that's coming out to bid, it's an occupied pool. So there is someone living in the property and they just don't know who it is because the borrowers have passed away. So this pool was really interesting, and I'm really excited about it because 80% of it's in Florida, which makes sense. And out of 2,700 properties, there's only 2 in poor condition. So that means, when we used to buy forward mortgages a lot, we always avoided vacant assets because those were the ones that had the worst condition. all these properties are in good condition. So that means there's probably a relative in there living in there to take care of the property, which means a quick deed in lieu, because now we have a straight track to the heirs or to the state. And so when we do our due diligence on this one, our agents will knock on the door, find out who's living there, and kind of get the story. So we'll have some additional intelligence. I was really pleasantly surprised when I looked at this pool. It's 80% Florida. There's Alabama, Illinois, and one other state. So we stay out of Alabama. Alabama's got a 1-year redemption period, and we don't bid New York ever. So those are the 2 states that we stay out of. But everywhere else, we'll bid. And Florida, there's some good parts and some parts where it's probably properties are inflated some. But if all the properties are in good condition and we have direct access to the estate through the occupants, they know what's coming down the pike, right? They know they're living there for free. So it's going to be a deed in lieu or a cash for key scenario.
Yeah.
Which then we just.
That affects our margin really well, that profit margin, yeah.
Yeah, then we compress the timelines. Although we still bid in, we're still going to bid in full foreclosure time plus costs. So that's just the upside, if we were able to compress the timeline.
Okay.
And do like paint and carpet or something, no rehab or no extensive repairs, because all these properties are in good condition.
Yeah, it's a couple. It's between that and then getting the compressed timeline, avoiding the auction. Yeah, that's where we really make those moves.
So,
anything else? Yeah.
Going back to the spreadsheet that I'm looking at that Jasmine shared with me, and I think it's from you, is the last column is, let's see.
Oh, the split, right?
The split,
Yeah.
the promote, is that how much? Like, I'm looking at the RDMO. This one shows about 407,517. Is that a running balance that's let's call it a profit over and above what you expected, or?
Yeah, so this is a calculated field based on every deal is structured differently. So it's given us an estimated promote all said and done when we are done liquidating the pool. So some of these we have a 9% preferred, some we have a 12% preferred, some we get 80-20, some we get 90-10, some we get 70-30. So it's an estimate. It's not a real number. It's forecasted. It's a forecasted number.
Is that the pool though to be split, or is that what your promote is?
That would be what our split would be. That would be our split of the promote.
Okay, so if you were taking 20%, or you say you were taking 80% and given 20%, that's 20% of what's in the balance of that promote amount.
Exactly. So for a good example is Beltway. So we've acquired 800 assets with them. So our deal with them is they have a 12% preferred, and I believe we split either 80-20 or 70-30, right? So this gives you an idea the money they're making, right? So they get 100% of the first 12%, and that 3.7 million is only 30% of everything above 12%. So again, that's an estimated calculated number. I have actual numbers in our financials, but yeah, we've done pretty well with Beltway. I mean, we've done well with almost everybody. There's a couple of dogs that we've had. Ballbeck, even though we did a decent amount of them, our deal with them was
Was it more low value?
no, it was real skinny because they have an asset manager platform. And so basically we're splitting fees with them. So our fees were super, super skinny. So there wasn't a whole lot of upside to that deal. And then, so everyone's a little bit different.
So are most of the deals where you take if it's 70-30, you take the 70 and the 30 goes to the investors, or is it vice versa? Because Jasmine's saying that our RDM 2 is 70% to the investors and 30% to us.
Right. We get the smaller share.
On all of those?
All of those, yeah.
Oh, okay.
Yeah.
So
So it's good for the investors. Sorry, Louis, go ahead.
Oh yeah, I mean, if you look at a lot of these funds, they provide an 8% preferred and keep 100% above that. That's crazy. So I'm used to working with institutional investors, and that would never ever fly.
yeah.
So when we start our Reg D, what we're doing is providing an institutional platform with institutional terms. Right? I'm not going to screw anybody over and say I'm going to take 100% over 9%. That would be highway robbery. So we're being very fair with our terms, and plugging them in. So these are all these investors, that they're all private equity, family offices, and one or two hedge funds. But they're all sophisticated institutional investors, except for RDMO, which is our first Reg D. So we give, every deal's a negotiation, but they're all relatively similar, close.
Yeah. That's why I'm excited to bring it, because we're getting to be on a platform here with all these big boys, right? Normally, otherwise, when you're sitting out there, Fidelity doesn't offer you an opportunity like this unless you're bringing 18 million to the table, right? So, yes.
The RDMO, you're calling RDMO RDMO, I'm assuming.
Yeah.
Okay, so RDMO 1, are there other ones in that, of those funds, that is very, very similar product mix?
Almost, yeah. We've purchased whatever's available.
Okay.
Whatever channel we've developed, we purchase with all our investors.
Okay.
So Baalbek, once the NSO trade was done, and the Heckams came around, they actually did not like vacant NPLs. So that's why they went away, and then we raised new capital for the Heckams. But other than that, every other, and except for an older one, like Javelin's was one of our first ones. So we only did forward mortgages and REO with them because the Heckams weren't even available then. But other than that, it's pretty same product mix throughout, because all those investors were I was going after whatever was available at the time with all of them.
So when you go to, say you go to the auction, and you've got a chunk of money from each one of these investors, and then you allocate it accordingly to what they have, or how Redmond 2 going to get, or how did Redmond 1 get their allocation of 105?
Everyone bids separately.
These are bought over that 5-year period or a 3-year period, and then the last 2 years are workouts, or how does that work too?
Well, there's no, so again, out of that 105, I would say probably about 50 to 60 are Heckams. The rest are it's either REO foreclosure sales. We did a lot of foreclosure sales for a while. So the pool, for example, this upcoming pool's got 2,700 loans in it. It's almost $1 billion.
Okay.
We could have all the money in the world. I'm not going to spend $1 billion, right? I'm not going to bid every single asset, because
right.
nobody. So I register 4 or 5 different entities for the same auction, and we just bid different assets. And there's generally every once in a while there's crossover, because some of my investors like to select the assets, and some investors I select them for them. So every once there's a crossover, but it's kind of a Chinese wall type of scenario. I'm not looking at the bids to say who's higher. I'm submitting the bids, whatever we come up with collectively. If an investor comes up with a price of 100, and then I have another investor comes up with 105, I'm just submitting both bids, and the highest bid wins.
So go ahead. I'm sorry. Keep going.
I'm not manipulating anything. It's just, but that rarely happens, because most of these investors have certain buy boxes. Either it's regional or it's value. For example, Castle Rock Capital, they only buy anything that's 60,000 and under. That's their business model. Like, so we stay away from that stuff. But they do very well on it. But I don't know exactly how they do it. And then we have other investors that are regional, other investors that have certain value bands or different property types. So some investors like Broll, some people like, SFR. So everybody's different. And everybody, it's odd because everybody will look at the same asset and come out completely different pricing.
So each one of your investors comes up with the pool that they put together their own pool of assets they want to buy.
Only if you come in from the partnership level, right? Like you're going to come in, not like you and I. But go ahead, sorry.
No, some do. Some of our JVs rely on us for everything. Some of our JVs want price guidance. It depends on the investor. Some want full boat services. Some are very hands-on. So it really just depends.
So do they look at the tape and they say, we want this asset, this asset, this asset, and that's where the crossovers come?
Some do. So for example, Beltway was our largest investor.
Okay.
So they would bid about 50% of the pool. So there was always some crossover with our smaller investors. But again, it's the highest bid win. So there's not much you can do. So
and you don't get involved in saying, Beltway's gonna say you've got RDMO 1 is bidding on a couple assets that Beltway's got, and you don't get in and say, you know what, Beltway's bidding on those and it's higher, and we probably shouldn't bid on that one.
So the investors like Beltway, there's a couple others in there. They like to select and come up with their own pricing. So what I tell them is, because they ask the same question, how do you know we're not bidding against each other? I said, just send me your bid sheet the morning of the bid and I upload it. And I won't even look at it. Right? I don't even look at their bids. For RDMO and some of the other ones where I'm helping them come up with bid amounts and all that, I still will get, prepare the bid sheet, get in the data room and upload it. But for the ones that are wanting to do everything themselves, they ask that same question, like, how are you not bidding against me? And I go, well, one, I'm not, but it makes you feel more comfortable. Don't even show me your bid. We'll just upload it the morning of the bid and then you're fine. So everybody is comfortable with that.
Okay.
But now the new capital that we're raising is going to be somewhat different. We're going to be hands-on with all the new capital that we're raising. So, but unless I raise $500 million, there's going to be plenty of assets for everybody. So there's just so many assets that it's easy to, like last pool, I think I carved out something like 350 really good assets that I wanted to bid. I don't have enough money to take 350 down. So that'd be easy to parcel up with small investors and then we go after them. So,
question then. So on RDMO 2 or RDMO 1, you were the fund manager and everything, I'm assuming. How do you get paid on all of this, a fee or is it an asset fee or a one-time commission or?
It's laid out in the PPM in our deck, but there is a capital raise fee. I think of 1%.
Yeah, 1% in that. Yes.
And then when we deploy capital, there's a 2%, I think, or 1.5% acquisition.
Yeah, I'll give it to you. I know it off champ.
Okay.
So 1% on the cap raise, and that goes to NAP. That's what you and I get for raising capital. Once we hit our first million. Then as far as asset management, which is separate, which is what Lewis handles with his team, it's not just him by himself, it's 1.5% on acquisition for us to acquire everything, get everything settled. And then there's 2% annual asset management if we're managing everything. And then there is 1% on the disposition. So if we're liquidating everything for you.
Okay. If I can see those documents, that'd be great to be able to understand them.
Yeah, I'll hand them to you.
And those are those are
Okay.
normal terms that I have with all the investors.
Yeah,
The only thing that changes is the preferred and the promote. That's the
Right.
one that kind of varies, but all those other fees are pretty much static.
Okay.
Standard, yeah.
I do have one quick question. One, I've got a whole bunch more, but as I read through these, PIMCO, I'm assuming those are your 4 loans?
We did, that's actually PIMCO Limited. So that was our parent company.
Oh, okay.
Yeah, they dipped their toe in on 4 REO, I believe. And I don't know exactly what happened with those 4, but yeah, we came about just about breaking even on that deal.
That's what I was looking at. It dropped your IRR on the whole portfolio down pretty bad. Same thing with 1,000 Keys, and that one's got more $29.7 million in it. But that's why I'm wondering if if I get a copy of the most recent spreadsheet and then tell me, or take out which ones that are odd and out of the norm, so we can see what an actual IRR. I mean, you've got some of them. Castle Rock, 50% IRR. Is that's an estimated, or is that estimated based upon what's going on today?
Can I just interject real quick? I just want to say, remember Castle Rock, before you answer this, they have a different threshold, right? They buy those lower margins, so it's a lot easier to make a quicker percentage. This isn't something that make out to the dollars, but at least from someone who deals with those lower values, it's a lot easier to make that. But go ahead, sorry.
Yeah.
So the 50% is their actual IRR on their liquidated portfolio. So they've so far, as of July, liquidated 125, and they've generated a 50% IRR. So yeah, like I said, they buy, they like the low value stuff, and they have a whole marketing arm. We manage for them, but we report to them. And so they have a kind of a whole methodology of buying low value assets. I would not go down that route because I don't feel like I'm an expert in that, but they are. That's all they do is low value stuff. CV, again, we did a decent amount with them. They had a specific buy box and they did, very well. Investment Funding Inc., we did pretty well. Yeah, I mean, it's easy to go south when you're buying just a couple of loans, right? Because it only takes 1 or 2 loans. If the more you buy, you spread out your risk. So, so the ones that have bought 4 or 5 and didn't do so well, my argument is, well, you need to keep buying. Because, you're gonna you get a dog every once in a while, but if you're only buying 2 or 3, that one dog has a big impact.
Yeah.
So you can see the ones that 1,000 Keys. So 1,000 Keys is interesting. They tried to run the Castle Rock model in buying low value assets, and you could tell they didn't succeed in that. And I told them when I first brought them on as a client, they were like, "We want low value assets." I'm like, "There's only one group I know that does that well, which is Castle Rock." So I advise them, do not go down this route. It's not going to work out. And sure enough, they came out break even.
And here's what I could tell you real quick too, is that when I got into the industry, that's one of the reasons why I was able to be sustained, because the smart hedge funds know their slice, right? They're not all over. And so if they see some low value, they're calling me to get rid of those, or something in bad, C or D neighborhoods, they know who to sell those to. And then there are certain people, as he says that, and I remember Castle Rock, that's where I started getting a lot of my little low values from. So there's certain people who specialize in that and can pull it off, but it's not for everyone. Same thing like hedge for these HECMs. I'll just say that because the people who I've seen who tried to go and buy to the auction without someone like us, at least for the first 5 or so rounds, they're going out there and they're being either outbid or they're paying way too much because they don't know the strategy, right? So, but anyway.
One of the reasons why I'm getting to where I was talking about that is there a way to take that spreadsheet and get rid of the ones that are not in the same expertise or the same products we're going to take, so we can kind of look at it and go, okay, Who's most like Art Redmond one?
So this tab right here, summary Heckham, this is just the Heckhams.
Okay.
So now I've excluded everything out because this is our biggest trade right now is the Heckhams. And, just the Heckhams were at 22% IRR and, almost 16% fully marked. So,
okay, that's what I'm trying to get to is get rid of the outliers and let us take a kind of a look and analyze the overall your track record on the Heckhams and maybe the REOs and things like that you're used to buying.
yeah, the ones that Northlight, we only did one deal with them. They're coming about 9%. They picked. They really wanted Connecticut, and then it's got some
That's
really
a tough one.
because
That's a tough one.
that fund is in
Yeah.
Connecticut, so they actually drove the properties themselves, and they actually wanted some for themselves, and they went after Connecticut. And Connecticut is a long timeline state, and
And
we
they're
have
tough.
we have some dogs in there that are still. I think we have 2 left in that whole pool, and they're just dragging on forever. So
They're
what-
really lender borrower friendly, like to the end of it. They're holding up. Yeah, it's amazing.
so except for some of the foreclosure sales that we did with in certain programs like CWCOT and SB 1079, where we absolutely just freaking killed it. Like, I'm not kidding you, like 200%, 500% returns. For the most part, if you're buying loans, if you're at a 15% unlevered IRR, you're doing amazing, especially if you're deploying volume. Like, that's a great number. So
Right.
what we run into is like the guys that are smaller and do more real estate stuff, they're all like, oh, I want a 200% return. I'm like, well, this is not the trade for you. 15, if you're not happy with 15%, to me, you're getting a little greedy. Because 15%,
Well,
and you can deploy a lot
risk
of
comes with reward. So
yeah. So 15 at a couple $100 million. I mean, that's a solid number.
Right.
Again, you can carve out some of these. Well, they did really well, like House Rock 50%, CV 48%. We did well with Kirkland 44%. And those guys are a little bit nichey, but you can see we didn't spend that much money with them, right? $5 million for a 25% return. Where Beltway, we deployed $140 million and at a 15% return. So you can get really nichey, you just can't deploy a lot of capital. So initially we can be nichey because our fund's small. So we'll be going after some of the Heckhams and some other unique stuff. But as we, our objective is to scale. Right, we want to deploy some serious capital, and that's why we're saying, hey, 9%, 12 preferred, 12 to 15% is where we think we're going to end up at. And the idea is that it's because we want to scale up, and those returns, those are good returns.
yeah.
So,
Okay.
every once in a while we'll knock it out of the park, and I'm sure every once in a while we'll have a dog. So
Going back to Beltway. Just so you took 3.7 million as your promote on that deal.
That's an estimate. We still have about 4 deals outstanding.
Okay.
So I've been paid probably over $1 million for sure over the last 4 years, and that we have 3 to 4 deals that should wrap up by the end of 26 that we bought, in 23, 24. So, we'll probably hit close to that number, but I don't think we'll hit 3.7 million. These are our forecasts, which doesn't sometimes necessarily match up to what the investor has. So, I would say at the end of the day, we'll probably be up to 2.8, 3-ish.
Okay. But still not a bad.
No, yeah. Heck yeah. And for Beltway, we did a deal where we put 0% capital in. So that was just we source the deals, we manage for them, and we didn't put up any capital. We're getting, pretty nice promotes on those. Actually, that's
Yeah.
all people here. So,
So I wanted to bring this up real quick too, just for Todd. So RDMO is the opportunity that we're speaking about as far as like people can get in minimum of 125,000. Now, because of I know where the sands that you and I play in, if you know someone who's got 3 to 4 million who wants to come and be their own line item, then we can go and bid for them and then carve out specific states and do the stuff like that. So just putting that in your pipe so you can.
Yeah, I'm just thinking if anybody, and once again, maybe dip their toe in the RDMO Redmond too, but they might have enough money to come in with a couple million later on after that and say, hey, I don't know. I'm trying to get to, like I said, warm and fuzzy.
Yeah, just get a feel for it.
Yeah, to where I can sit down and talk to somebody and say, I haven't done this in years, and I didn't do this part when I was at Goldman. Most of what we did when I did work for the Goldman and the Lehman and all those is we analyzed the loans and took them to the committees and said, okay, this is a apartment complex in South Florida. Here's my value on this. Here's an industrial property out in the middle of the desert. My recommendation is insure it and burn it. So
yeah,
good news
that
is
was
that
always the
you can
joke.
see that
What's
because
the
you're
highest
analyzing-
value? You put an insurance policy on it and you set it ablaze.
just
I think the good news is because of your background, you can see that it's still a conservative but very wealthy place. So
Yeah, no, it's not the 30-40% returns they were getting back then in the 80s and 90s, but those funds were getting some pretty good returns. But this is more, I mean, it's 15% return on your money over a 5-year period is pretty good.
especially with the risk, because the underlying risk, you've got some nice collateral underneath it. That's
Yeah.
what I'm talking about. So, but
Yeah.
yeah, I got this recorded so we can watch it over again and make sure we're fluid. And then if you have any other questions, you know where to find us.
Okay.
And then I'm going to try to get you to come to the meeting that we're going to have in office next week. But I'm still just trying to make sure it was on Monday or Tuesday. But I'll keep you posted.
Yeah, keep me posted because the more notice I have, the easier I should be able to sneak out. The only big thing I have right now is when my tickets go live for the Padres, I spend the whole day moving tickets around for everybody and ourselves and Lewis, if you want, shoot me a text or an email with your phone number and or you can send him what I sent. Well, yeah, send me and I'll forward on what I sent to
Yeah, because he
Yes.
knows what like the giveaways are going to be every week, and then we should also just go out one day as a team so you can check it out. But we have fun together, so
yeah.
Yeah.
But also,
What's
go
that?
ahead.
that'd be cool. I've
Bring
never
the
been-
family. I mean, yeah, it's a lot of fun. If you haven't been to Petco since they opened Petco, man, that's 20-something years ago.
I know, it's crazy. Everybody tells me what a great stadium it is.
Always,
But you should
it's
come down
awesome.
with the kids and the grandkids. If they have like a play area for them, it's real clean too.
Yeah.
Oh, yeah. Gallagher Square, they remodeled it about 3 years ago, and I was really concerned because, sometimes when they do this, they take away the family flair or the family friendly type thing. I remember when Petco first opened, day of the game, you could go in for $5, go out Petco, what they called it wasn't Gallagher Square, it was Park in the Park or something back then. It was $5 to go sit on the lawn out in the outfield out there and just watch the game on the big Jumbotron. Or now those price tickets can be pricey, but they have a whole Tony Gwynn pavilion out there. They've got a little ballpark where the staff sits there and they'll play a little kind of mini ball with the kids and a playground and a dog park, and it's worth going if you've never seen it. But yeah, somehow give me your contact information. I'll send you what we got and let's pick a game.
Yeah.
Tell me how many tickets you need and we'll every Sunday is Kids Fest. where they've got a Gallagher Square set up for the kids to play, you know, different bounce type things or throw pitches at, you know, a pitching machine or things like that they can do. It's just a couple times a year or several times a year, they have a free giveaway for kids on
We'll share a group text with everyone right now so that you can get that information to them, okay?
Okay, I'll do that.
Thank you so much for your time, Louis. Go ahead.
Thank you, Louis. I appreciate it. I'll start looking through all this stuff and look forward to doing this. It sounds more every time I talk about it, it's a little bit more interesting, and I'll bring it up to people and they'll go, "Oh, that sounds interesting." But like I said, if I'm putting my reputation on the line, I need to know everything.
Absolutely. Yeah, well, feel free to reach out with any more questions, and then we'll talk soon for sure.
Okay, sounds good.
All right, bye-bye.
All right, bye.
Bye, gentlemen.
Bye.